Hi, my name is Natalie. I am a accountant here at Collective. Today we are going to be talking about lowering your tax bill through an S corp. So I'll go ahead and give some time to let people trickle in. Um, Looks like we are waiting on. Let me just make sure that we have everything rolling correctly. Um, so today, this is just a kind of a brief overview of the agenda today. We're going to be talking about taxes you face when you're self-employed, how S corps can help you pay less in taxes and why you should start now. And then we're going to go ahead and talk about estimating your taxes and how Collective makes that a no-brainer. Then at the end, we'll go over a Q&A portion. I'm going to pause just for a minute to make sure we have everything rolling correctly and that people are able to get in. It looks like we might be having some technical issues. So I'm just going to pause for a moment. While we're looking into that, there is some etiquette for today's webinar. Any questions that you have, go ahead and drop those in the Q&A box so they get answered live towards the end. The chat function, a lot of times people get confused and put those Q&A questions into the chat function, but the chat function is for more instant feedback or questions about audio or visual or just general feedback to me as the speaker. At the end of the webinar, we will be sharing a discount. So go ahead and use that webinar code. And then I encourage everybody to join our webinar updates group on LinkedIn. You can go ahead and take a picture of this webinar that's happening live. You can give us a shout out on social media. The webinar replay does get sent out 24 hours after to all the registered attendees. So you'll get a copy of the slide deck that I'm presenting today. And then any inquiries about this webinar can be emailed to webinars@collective.com. So I'm going to go ahead and see how we're doing here. Okay, still waiting for people to kind of trickle in, so I'll hold on the agenda. Okay, you know what, we're just going to go ahead and keep rolling since we're live. And if you were unable to get into the webinar, you will get a recording after the webinar. So I'm going to go ahead and dive into what we have going on today. So what and who is Collective? We're the first all-in-one back office platform designed for self-employed people. This is currently our niche. We are big proponents of businesses of one helping make running an S corp easier. All right, so here are some of the challenges that you may be facing as a self-employed person. You have potentially a surprise tax bill. You're facing ongoing compliance. You have to think about federal taxes. Maybe you're not sure about what business deductions are appropriate for your industry. You're thinking about estimated taxes. What does that even mean? You're thinking about self-employment tax. You've just heard about it. You don't really know what that means either. So now you're guessing how much you owe. Do you have enough to pay? And could you potentially face penalties? So this is how you feel when you're trying to figure out your taxes. Probably confused. How do all of these things tie together? How do I estimate? Am I putting away enough money? Will I face penalties? We're going to do a live poll, or typically we do a live poll about what stresses you out the most when it comes to these taxes. We're having a couple of technical issues, so I'm not going to run the poll today, but it could be, some of these structures could be paying taxes, being hit with a large tax bill at the end of the year, potentially feeling like you maybe be paying too much in tax because of that self-employment tax. And maybe you didn't even know that these self-employment taxes existed or that you needed to estimate taxes. And maybe your stressor is that you forget to pay things on time, or finding someone to do this. So if this sounds like you, let's talk about let's just take it back a few steps and talk about what kind of taxes you potentially are facing. So the taxes for a self-employed person or individual are income taxes. And that's generally what we think of when people say taxes. So these are individuals, and they are paying between 0 and 37% based on the tax brackets. Self-employment tax is a flat rate of 15.3%, and that goes to Social Security and Medicare. As an employee, half is paid by your employer, and then you as the employee pay half. But when you're self-employed, you paid both halves. The IRS wants their cut no matter what. So they want to make sure that as a W-2 employee, they're getting your taxes as you're earning the money. And same thing as a self-employed person. They want you paying quarterly tax estimates. So why are self-employment taxes so expensive? Well, Social Security and Medicare tax, you can see here, this graph visual really helps drive this home. You're a self-employed person, so you're paying the full 15.3% on the money you earn. In this scenario, it's being split. So you're the employee, you pay half, the employer pays half. You as a self-employed person are on the hook for all of it. So this graph just helps us understand even further how these taxes are flowing through to you. In this scenario here, we have revenue minus your tax deductions. So those are your expenses that you incur, and the result is the net income. You can either have negative income, which is a loss, or profit, positive, and that flows through to you as the owner on your personal tax return. So your business profits receive 15.3% in self-employment tax, and then you pay income tax on both your business profits and all the other personal adjustments you might have. So you might have other like rental income or investment income. And then maybe you take the standard deduction or you itemize deductions, so that reduces down your AGI, and that's what you pay income tax on. But all of your business profits are going to be subject to that 15.3%. So what is an S Corp? First, let's back up a little bit, because this is where we get into a lot of confusing abbreviations. We have the LLC, the single member LLC, LP, LLP, Inc. What do these mean? These are all legal entities. So they're distinct and separate from the owner, and they're formed at the state level. So the most common ones that I run into are an LLC, limited liability company, and a C Corp. So a C Corp or corporation and an LLC are both formed at the state level with the Secretary of State. So you're typically required to file like an annual report letting the state know that who manages the entity, the address, some more legal information about the entity. This is not your tax return. It's just a form that gets filed with the state. So formation and information returns are done with the Secretary of State with the state that you reside in. And this is usually completely different than the taxing authority. So how is an S Corp related to a C Corp or an LLC? Well, first, and let me just go into this slide here. An S Corp is actually a tax election. So the IRS assigns every business their structure. It's a default tax treatment. So that's just a fancy way of saying that the IRS decides how each business structure is taxed. Single member LLC. So if you're the sole member, on your LLC, you're automatically taxed the same way as a sole proprietor unless they ask you otherwise. So as an S Corp, you're asking the IRS to tax your single member LLC under the rules of an S Corp. That means your LLC stays at the base. You're just changing the way that you're taxed. Why does this matter? And why are S Corps so great? Well, S Corp owners, if they layer that S election on top of their LLC, those owners don't pay self-employment taxes on their profit. But here's the catch. An S Corp creates an employer-employee relationship between you and your entity. So you become an actual employee of your S Corp. Then that requires you to give yourself a wage from your business, another term for it's reasonable compensation, and that is done via W-2. The benefit of that is that you're only going to pay payroll taxes or that self-employment tax on the W-2 wage portion. So payroll taxes, when I say payroll taxes, I'm typically meaning that 15.3%, which is the self-employment tax. It gets siloed onto the W-2 wage you pay yourself. So half of the payroll taxes that are withheld from your paycheck are remitted immediately. That's your tax deposit as an employee of your company. And then half of those taxes, your business remits as well. And that's an expense to your S Corp. Okay. So let's look at the difference here with an S Corp taxation versus that previous graph we had where we were looking at just a normal sole proprietorship. So with the S Corp taxation, we have all revenue is run through the S Corp, through your business. So you have revenue, and of that revenue, you give yourself a salary, and that salary is the piece that's subject to the payroll taxes of 15.3%. And then you have expenses. So the result of these two things is once you run the expenses through your S Corp, you have profit or loss. We have the owner's portion of that salary plus the profits flow through to you on your individual return, and that's where you pay income tax. So that's your federal tax and state tax rate of income tax. So all of that profit's subject to that. Okay, so let's kind of look at this. I love this head-to-head comparison graph because it really helps drive home the concept that we've been talking about as a sole proprietor or a single member LLC. So think of sole proprietor think of that as if you're just doing 1099 contract work under your social security number, or maybe you did a DBA or you did get an EIN, but it's still linked to your social. So think of that as sole proprietorship. A single member LLC is when you're forming a LLC at the state level and you're probably operating under an EIN that's linked to that LLC. So both of these entity types are subject to receive a 1099. So think of that falling under this column, and then an S Corp, which you can either have a C Corp or a single member LLC at the base of the S Corp. But think of, for the purposes of this presentation, we'll think of it as having the single member LLC with the S Corp designation on top. Okay, so here's the difference between the two. As a sole proprietor or single member LLC, all of your profit, the 160, is subject to that 15.3% in self-employment tax. So right off the bat, you have $24,480 just in self-employment tax. Then you, as an individual, pay income tax on it on your individual return. So you're getting hit hard two ways. With the S Corp, The 60,000 of this we've set aside to run through W-2. So that's the owner's wage portion. So you still have profit in both these scenarios. You still have profit of 160, but as an S Corp owner, giving yourself that W-2 wage, the self-employment tax shifts. So instead of being on the full 160, now it just shifts onto the 60,000 you're paying yourself. And the result is, instead of paying 24,000 into self-employment tax, now you're paying 9,000 for a tax break of 15,300, which is significant. That's money, money you can reinvest back into your business, money you can invest into a more aggressive retirement plan. You could see that there's a big significant shift there. The 100,000 you see here, this is what's subject to income tax. So it's still your money to take out of the business, right? You're going to pay tax on it, whether you take it out or leave it in. But by taking this salary, the 100,000 you get to take free of self-employment tax. So that's the big benefit. All right. So at Collective, we like to call the S Corp, the small business owner's best friend. And why? It's because not all the profit that you earn from your business, maybe because of work, right? Maybe you're subcontracting it, some of your work. So why would you subject yourself to paying FICA on all of that money? FICA, and when I say FICA tax, I mean the self-employment taxes. Some of that profit you may want to put back into the business and building the business. Therefore, you want to be more strategic about it. And that's why the S Corp can be your friend. The S Corp, it also recognizes that, maybe you're not a corporation with a large suite of, corporate officers, and you don't have a lot of separation from your business. Therefore, these layers of taxation aren't necessary. So it kind of gives you a good hybrid of both. All right. So let's dive into which is best for you, LLC or S Corp. LLC is wonderful. It gives you the liability protection. If you're new to business with unpredictable revenue, it could be a good way to sort of get your feet wet and just understand the profitability of your business. If you know for certain you're going to earn less than 60,000 in profit for the year, it's probably not worth the additional compliance to switch to S Corp. And if you just want something that's simple and straightforward, with not a lot of red tape, but you want to have some separation from your business, then LLC might be the right route for you. The S Corp is really best for those who earn more than 60,000 in profit per year. So we want, this could be, it could be 60 to 80K, depending on what state you live in, because some states do have tax on the S Corp at the state level. Really, you'd want to advise somebody, schedule a call with us, and we might be able to help you understand, based on what state you're in, sort of the threshold for switching to S Corp. But generally, it's someone that earns more than 60,000 in profit per year. Maybe you want to maximize retirement contributions. So for most retirement, Roth and solo 401k, the contribution jumps from 20 to 25% with an S Corp. So if you really want a vessel to kind of maximize those retirement savings, then the S Corp is right for you. And maybe you're in a position where you have enough cash flow each month where you can run those regular payrolls. So what I mean by that is, because you're an employee of your company, you want to be able to cover the cost of running payroll and withholding tax on that on a regular basis, whether that's twice a month, monthly. You get the idea. All right. So getting a salary through my S Corp is great, but how much do I pay myself? So this is a really big hot topic. You might have seen a lot of opinions floating around on TikTok or Instagram about this reasonable compensation. The reality is there's really no set standard for reasonable compensation. It comes down to facts and circumstances argument. So generally, like, how much would it cost me to hire someone to do my job? Well, that gets a little tricky, right? Because if you're earning 60K in your S corp, you probably couldn't go out and hire someone at 60K to do your job. So when the net profit of the business is more like 60,000 to 200,000, you're probably looking at more of a percentage range to get that right reasonable compensation number. So generally between 35 and 45% of the business profit passes what we call the smell test, since there is no set formula for you. And it's usually just how the numbers end up, kind of shaking out. So here's a little graph. This is what we have available to our members on the collective dashboard. Let's say this person is expected to earn 130 in profit. What that means is after expenses. So they have revenue in their business, they have expenses. The resulting net profit for this individual is 130,000. So in this range, 73,000, we've said this is a good defensibility in an IRS audit. That's a safe range to be in. And these are the potential tax savings. And then you sort of have like your state minimum. So, your tax professional can help you pick a number. This is something we support our members through. So if you've been curious about switching to this, schedule a call with us. We can help you understand what that number would look like for you on a very general level. All right, so let's talk about estimated taxes, because we have a tax payment that's coming up in April. April 18th is when it's due. What are estimated taxes? Why do you owe them? So generally, those who should pay estimated taxes are anyone that thinks they could earn over $1,000 or more. So like an independent contractor, someone that has their own business, someone who files as a sole proprietor. Maybe you own a share in an LLC, so you're a member in an LLC. And another thing to remember is that there are state and federal tax estimates if you live in a state with income tax. So today we'll concentrate on federal tax estimates, but because states have different rules, but you'll need to look into those and follow those. So the big question is, are you earning income that doesn't have withholding? If the answer is yes, then you should be paying estimated taxes. Okay, why do I have to pay these? Well, again, the IRS, they use a pay-as-you-go system. So when you have a normal W-2 job, your taxes are withheld, right? You get a net paycheck, and then you look at your pay stub and you're like, dang, I pay so much in taxes, right? The same thing applies to you as a self-employed person. You need to, except it's on you. You have to estimate how much you give to the IRS each quarter when you don't receive a paycheck and you don't have withholding. So how do you do that? I want to make sure I didn't miss a slide here. Okay. So here are the estimated taxes basics. Okay, so taxes must be paid as you earn or receive income throughout the year. I know I'm keep repeating this, but it's important to understand that. If you don't, you may have a penalty. You must make estimated tax payments if you expect to owe 1,000 or more. If you don't pay enough through the tax withholding and estimated tax payments, you may be charged a tax penalty. So that means even if you do pay in quarterly, but you don't pay in the right amount, you could also have a penalty. You may be charged a penalty if your estimated tax payments are late, even if you're due a refund when you file your tax return. So if you don't make that quarterly tax estimate and in time, and you get it after you've calculated all your personal deductions in, it turns out you're going to get a refund, but you still didn't pay in what you owed on time. So you could be subject to a penalty. So estimated taxes, they are due on a quarterly basis, April 15th, June 15th, September 15th, and January 15th of the following year. If that due date falls on a weekend or a holiday, then it's pushed to the next business day. Okay, so let's get down to business about how you estimate your federal taxes. Okay, so there's really two different ways. Estimated tax can be paid through like the safe harbor rule. So you pay the lesser of these two. So how it works is you can pay 90% of the current year's taxes. So I just went with small, easy numbers here. You estimate you'll owe $1,000 in taxes this year. So you multiply $1,000 times 90%, that's $900 total that you owe. Divide that by the 4 quarters, and 225 is what you will pay as your estimated taxes each year. And then you take 100% of last year's taxes. So let's say you owe $2,000 in taxes last year. You divide that by 4, you get to 500, which is what you would pay as your estimated taxes each quarter. So you take the safe harbor rule allows you to take the lesser of either of these instances. Okay, so then there's this way of estimating your taxes based on your actual income and deductions. What does that mean? You want to estimate what your adjusted gross income is. So that means all of your income that comes in from different places, your business profit, your spouse's income, your rental, your investment income, all of that, minus certain adjustments. So any adjustments, and then you multiply your AGI by your applicable tax rate. So AGI times your tax rate, that's your estimated tax payment for the year. You divide that by 4 to determine how much you pay each quarter. So that's taking into account your actual income and deductions that happen that year. I know I mentioned this before, but estimated taxes are not just for the IRS. The states have them too. I'm in California, so I just went with this simple example. California, generally, let's see here. In this scenario, generally, you must make estimated tax payments in 2024 if you expect to owe at least $500 or $250 if you're married. That's almost an absolute guarantee for anyone that lives in the state. You must pay you must pay 90% of the current year's tax or 100% of the prior year's tax, whichever is smaller. The difference here is that California requires, it's like a different amount that you pay each quarter. So 30% of the estimated tax is due on April 15th, 40% on June 15th, and 0 on September 15th. So 30% of the estimated tax then gets paid on the following year on January 15th. So you just get a little break in September, essentially. All right. So what happens if we don't pay these taxes? You can be subject to let me go back here. You can be subject to underpayment, penalty, and interest when you go to pay your annual tax bill. So also, if you're not paying in, this means at the end of the year, you have a big tax bill waiting for you that you didn't expect. Maybe you saved for it. Maybe you oversaved. Maybe you could have been using that money. Maybe you're just like, I'm scared. I'm going to put away 35% of my profit. So in that case, maybe you oversaved and you could have been using that money better for your business or for a more aggressive like retirement contribution for yourself. So even if you're due a refund when you file, again, you'll still be hit with an underpayment penalty because you missed paying those estimated taxes as you were earning the money. So the IRS, they will calculate the amount of that underpayment of tax based on the tax shown on your original return or the most recent return that you filed before the due date. So the tax shown on the return is your total tax minus your total refundable credits. The IRS calculates that penalty based on the amount of underpayment, the period when the underpayment was due and underpaid, and the interest rate for underpayments that are published quarterly. So not fun. Make your estimated payments. All right. Estimated taxes as a sole proprietor versus an S Corp. So what's the big difference here? As a sole proprietor, you're not going to have a W-2. So you're going to have no withholding other than what you do for yourself. So you must estimate the amount of income that you expect to earn during the year and then pay estimates on the entire amount. With the S Corp, you pay yourself as an employee. So you do have withholdings on a portion of your W-2. You can also choose to increase your W-2 withholdings to account for the other income earned during the year. If you don't increase those W-2 withholdings, then you do have to estimate income that you earned above the salary you paid yourself. So thinking back to that scenario we looked at, where the individual gave themselves $60,000 in owner's paycheck or owner's wage from the S Corp, the remaining $100,000 they earned over that, they still owe income tax on it. Therefore, that tax needs to be estimated quarterly. Okay. All right, what can you do now to make your 2024 tax payments lower? Potentially, you should consider an S Corp ASAP. This will maximize your take-home pay this year. So you're going to be accurately estimating Q2 estimates and quarterly estimates going forward. You can maximize your take-home pay and optimize the tax payment with an S Corp. On average, our members are saving $10K a year. So when it comes to understanding if this is right for you, I highly recommend scheduling a call with one of our professionals. They're available to answer questions and look at your specific situation. There's also a peace of mind that goes with switching to an S Corp. And maybe this is something that's been on your mind for a while, is getting more structure around how you pay yourself and pay taxes. When you do this, you're giving yourself income reports. So when you switch to an S Corp, you're going to start keeping track of your financial records. Collective would do that for you. And this will help you understand your tax deductions better, your net profit better, and how much you can pay yourself. Also with Collective, you'll have a team backing you, keeping an eye on things specific to your business so that you can continue to focus on your revenue. And we've talked about today the tax savings with an S Corp, how substantial they are. But the fact is that running one can be complex. You have formation, maintenance. You need to understand what's going on with your financials on a monthly, quarterly basis. These things are critical to making sure you're operating correctly, but they can also they just add complexity to your day-to-day operations with your business. Because at the start, if you're just operating as a sole proprietor right now, you need to think about forming an LLC, getting an EIN. An EIN is your, essentially it's your ID number that your business has that it operates out of. If you're not already an S Corp, or if you don't have an LLC in place, part of the formation is also doing the S election. So in order to do an S election, the LLC has to be formed. We have a due date coming up on March 15th. That is the due date to file your S election for 2024. So that means if this is something you want to do for this year, if you want to put yourself on payroll and change your structure, your S election is due March 15th. Now it's, not the end of the world if it doesn't happen before March 15th. You do have the option to do a late election, but that also comes with more complexity. So if this is something that's been on your radar for a while, I highly recommend book a call with us or talk to your CPA about getting an S election in as soon as you can. The next part of the formation is really just registering as an employer, because you're going to be opening up employer accounts in the state that you live in so that you can put yourself on payroll. These are things that Collective handles for our members, but those are just things to keep in mind. With formation, there is, we're dealing with state agencies. There's delays, things come up. It's tax season right now. So the sooner the better. You don't want to, you don't want to wait on a lot of these, a lot of these employer accounts. So the ongoing maintenance is, you'll have state compliance, which means that we touched on this earlier in the webinar. You have the Secretary of State filings that happen they happen each year. You need to, make sure that that salary you're paying yourself as the S Corp owner is correct. Most people need to have a payroll software to do this on. When I say payroll software, think of like ADP or Paychex or Gusto. We utilize a software called Gusto. They power the payroll piece. You also have quarterly tax calculations. Some CPAs charge for those quarterly. That's something that we include in the Collective membership. And then you'll also have annual state and federal income tax returns. I think this piece can confuse a lot of people with the switch to an S Corp. You actually separate from your business for tax purposes. So your business has its own return that's due every March 15th for the prior year. So it's coming up. We're getting close to tax day for 2023. And then you also have your individual return that's due April 15th. So the ongoing maintenance with the S Corp is to make sure you file that business tax return by March 15th, or if you go on extension, it's extended to September 15th. The last sort of piece of an S Corp is making sure you maintain accurate and consistent bookkeeping. So you want to be producing a profit and loss statement each month. Well, what does that mean? It means all the transactions that run through your business checking account, your business credit card, those should be organized into a profit and loss that reflects income and expenses that occurred in that month. The reason, again, that this is important is it helps you understand how much you can pay yourself from your S Corp and that you're setting aside enough money for those quarterly tax estimates. You'll want to have financial clarity because you want to understand your retirement, your fringe benefits. How much can I put away into my solo 401k? These are some of the complexities that we've covered. All right, so are you thinking about switching to an S Corp? Well, the good news is that Collective is currently in all 50 states. We support all the things that we covered today, S Corp setup, the taxes, ongoing state compliance, reminders. We can give advice on your retirement contribution. How do you set up, writing off your health insurance premiums through the business? You have ongoing support. There's a relationship manager that's assigned to each of our members. That person is going to be there to help you navigate some of, the things that come with being a business owner, like getting notices or just general questions about what you can write off. Our membership also comes with a Gusto subscription, which means that you don't have to pay or worry about setting up and managing a payroll software. We do that for you, and Gusto powers the payroll piece. Ongoing bookkeeping support. You have a bookkeeper assigned to your account each month, so they're going to keep track of those income and expenses related to the business through our collective accounting support. All right, so what can you expect if you work with Collective? We will handle the formation. We'll form the LLC, file for you to be taxed as an S Corp. We obtain the EIN. We'll review the retirement plans and contributions you plan to make. We'll make sure that health insurance is correctly booked, and then we'll talk reasonable compensation. How much should you be paying yourself from the S Corp? Bookkeeping, a lot of times people are coming to us, mid-year. I mean, we're already almost 3 months into the year, so there might be some catch-up bookkeeping to do. We're here to support you through that. We'll also train you. What should you be writing off? And and we'll train you on how to read your P&L, how to analyze it, how to understand your net profit. The ongoing support is that each month the bookkeeper is categorizing transactions for you. We're sending you reminders about your quarterly tax estimates. We will help you with a compensation adjustment if you have a dramatic change in your revenue and we need to reassess how much you're paying yourself. We send reminders about filing state paperwork, and then you have a team that's there. They're there to help you answer questions and just give you peace of mind with all of this. In terms of taxes, we're doing the business tax return, that one that I mentioned that's due on March 15th. We prepare the state and federal return and do the estimated tax calculations and reminders. So this is typically interactive. How much do you think collective cost? Well, we are $349 a month. So what that includes is all of the things I've listed. Keep in mind, you're not paying for an accounting software. You're not paying for payroll software. We're covering all the software costs and including all of that amazing support that I mentioned. And we're doing the formation. So you don't have to run out to, a LegalZoom or something like that to set up your LLC S Corp. We do that for you. And then we can act as your registered agent going forward. So all of that's included in this $349 a month. The one-time $199 onboarding fee that encompasses all the setup that I mentioned. So just making sure, like, if you have an LLC in place, we're going to verify that it's in good standing. If you're an existing S Corp, we'll transfer your payroll from your current payroll provider over to Gusto. All of these things take so much time, and we're doing it just for a flat $199. The employer registration, like if you aren't set up as an employer already, we do that on your behalf. And then any catch-up, cleanup, bookkeeping, we'll do that. There's no limit to, how much we'll do there. All right, so collective pays for itself immediately. Your membership is tax deductible. So it's a write-off to the business. Everything we provide is, cost effective. And we're running an amazing promotion right now. It's your first month free and no onboarding fee. So that's valued at $550. You'll want to use, you'll get the link in the slide deck, or you can scan the QR code. This offer is valid through March 31st. You do want to schedule a call with one of our advisors. I used to work on that team. Everybody is amazing and ready to help answer all of your tax questions and see if this is the right route for you. So go ahead and schedule a call with one of our tax advisors. And if it seems like the right fit, take advantage of this awesome offer. You get to get started at no cost to you with all of those things that I mentioned. So now is when we usually shift to a Q&A time. Due to some technical difficulties, we will not be doing a Q&A today. However, I just want to reiterate, if you have questions for me after watching this, please send those questions to webinars@collective.com or schedule a call with one of our tax advisors. They are on standby. They'd love to meet with you and, again, see if this is the right fit for you. Some due dates coming up. I just want to reiterate, March 15th is the due date to file an S election. So if you are an existing LLC, that due date's coming up. Now, if you don't make it in time to do it, that's okay. You can file what's called late election. Collective would do that on your behalf, but there are a few moving pieces here. We want to sort of, make sure that we're addressing. If you want to be an S Corp, that you're doing it in a timely way. We're kind of getting in farther into the year, and a tax estimate is coming up on April 18th this year. So there's just some strategy at play there. So keep those things in mind. We'd love to meet with you. And please take advantage of that discount code if this seems like the right fit for you. Thank you, everyone, for joining, and have a great day.